Welcome to another episode of Beyond the Deal with Vehano Joseph. This is a show dedicated to all levels of entrepreneurs looking to scale and improve their lives. So let's dive on in with our next guest. Hello, Beyond the Deal Nation. Today, I'm super excited to welcome a guest here, Brian Briscoe. He's the founder of Streamline Capital Group and Tribe of Titans. Brian is a multifamily real estate investor, mentor, and the host of Diary of an Apartment Investor show. He's built a business that helps investors grow their wealth through apartment investing. Brian, welcome to the show.
Thanks, appreciate it.
Yeah, Brian. So very excited to have you here, and let's dive into your background. I did a bit of research, and I see you spent years in the Marine Corps, and thank you for your service. What led you to multifamily?
What led me to multifamily is it really started. I think everybody has heard, your house is your biggest investment, which I don't think is accurate. It shouldn't be accurate for most people, but that's something that I think people who sell you homes have propagated. But, growing up, it's like, hey, your home's your biggest investment. My parents followed that pattern, and most of their net worth is sitting in their home as well. So come 2001, I was in grad school. Talk about the Marines for a second, but just kind of roundabout way to answer the question. When we had the terrorist attacks of September 11th, I decided to join the Marines, dropped out of school. And long story short, I was moving every, 1, 2, 3 years. I wasn't in the same place for very long. So home ownership for me wasn't really an option, and I really wanted to be able to buy a house and start building equity. And so we started buying rentals instead of buying a house every time we moved. And we tried to do that a couple of times and it worked. Yeah. We picked up a couple of rentals along the way and thought, okay, well, I'm not building equity in the home that I live in, but I'm still going to be building equity. And so that's what got me into single family, is just, not being able to easily buy my own house as an owner occupant, and then trying to figure out how can I solve that problem? How can I start getting that equity build up, which once again, we're told is the best way for most people to build wealth. Once again, I don't believe that, and then several years later, similar issue is I see that, most of my net worth is sitting in a couple of rental houses, and, all my other investments have done, they hadn't performed as I'd liked. And so when you start looking and comparing my real estate investments to, my retirement fund, which is where at the time all my other investments were. My real estate investments were getting double-digit returns. I mean, every year, double-digit returns, and my K equivalent was not. And so the next thing I was trying to solve for is, okay, how do I do this faster, and how do I do this better? Explored lots of different options. I read books on sub 2 before sub 2 was cool, lease options, and lots of other ways to do it. But before the BRRRR acronym was even a thing, I was reading books on how to do that, right? And so I was just looking for ways to scale. And then I honestly accidentally bought a book on Amazon about, small apartments, and
Do you recall what that book was?
It was by Brandon Turner, the, former Bigger Pockets podcast host. I think most people know who Brandon Turner is.
Yeah.
But it was a really short book, and it was like how I bought a 24-unit apartment with with almost no money down, and it was on a deployment, and, we didn't typically have reliable internet access on deployment, like Wi-Fi for our phones or whatnot. Yeah. And every time I did, I'd download a whole bunch of books on real estate. This is where my mindset was. And like I said, I accidentally downloaded that one, and I got to the end of my list of books, and I'm like, that's the only one I haven't read yet. And that's really what kind of opened my mind. At that time, I had no idea who Brandon Turner was. He didn't have a big, long, full beard. He's a guy, a weird looking dude, on the cover in front of an apartment complex. When I read that, I'm like, this makes sense. He's doing the same thing that I want to do, and that's scaling. And he's getting 24 units at once.
Like
that
one
sounds
house at a
like
time.
Yeah. So that's really what got me into it. And then, It's probably 2016, 2017. That's when this deployment was, October to May, 16 to 17. But it was probably 2017 that I decided apartments is what I want to do. It was almost 2 full years later where I realized that I was going to need help. And then I got into a coaching program. And that's really kind of like the hockey stick moment where I was getting into that coaching program. But yeah, prior to that, I was spending 2 years of listening to every podcast on multifamily, reading every book I could find. Yeah. And I was still exploring other areas too. But yeah, that's essentially it. And then bought the first 3 apartment complexes in 2019. Every year since, we've added to it.
Amazing. And it just shows you how important your mindset is in all of this, asking better questions, trying to figure out how to scale. It's funny, we started it at the same time in 2017, and I started with a duplex down in Tampa and then grew this whole portfolio to over 3,000 units. So it's definitely it's a way that you change your mindset, and you have to and really understand, even taking that back to when you were doing single family, you saw there needs to be a better way to scale my wealth, and having that ability in multifamily is really, really great with the way the appraisal systems work and all of that. So awesome. And what was one of the biggest challenges you faced early on in the switch from single family to multi?
Well, I mean, the first thing is exactly what you said. It was mindset, and it was kind of a big mindset shift that got me to actually join the coaching program. Because I was, every time you go to the podcasts, most of the podcasts that were, widespread at the time were about syndications, and that is what I ended up landing on. But I was looking at the syndication and, going and raising private capital. My mindset said, I can't do that. I can't go raise private capital. I'm a military guy. Nobody in my family, is going to be able to pull more than 10,000 together at any given time, and so I was, sitting thinking, I can't do the syndicate. And so luckily I started going about, okay, so what can I do? And I started thinking about what I could do. And I'm like, well, I've got 6-figure equity in a handful of single family homes. I'm like, what if I sold all my single family homes? If I sold all my single family homes, I'd have, $200,000, $300,000, $400,000. I think at the time it would be about $300,000. But then I started looking at, okay, down payment, that would buy me about $900,000 to $1 million in real estate. I started looking at what I could buy, and where I was at the time, that could buy an 8-plex, and so I started looking at 6s and 8s and things like that, and finally paid to go to a conference, and it was like a $300 ticket. And the only reason I went to the conference is because it was about 4 miles from where I lived, and it's just like, I might as well, at this point, my mindset wasn't open enough to be able to, see the value in traveling to go to conferences. I decided to go to this conference, and I remember sharing with somebody, what I was trying to do. I'm going to sell my single family homes. I'm going to buy an 8-plex. I'm going to run that for a couple of years, and then I'm going to see if I can, start syndicating, and of course, we're in a room full of syndicators at the time. And then this guy put his hands on my shoulder and kind of turned me around. We were in the corner of a networking area, and he pointed to everybody there. He's like, there's a lot of people over there who are, not as good as you, not as strong or smart as you, not as, responsible, not as, and they're all syndicating.
Mm-hmm.
He's like, you don't need, yeah. He's like, you don't need to start with a 5-plex to be able to start syndicating. So you don't need to do that. And, when he first told me that, I'm like, okay. I don't know if I believed him immediately, but luckily it was at the very beginning part of the conference. And this conference had a lot of networking opportunities. And I went out and I started talking to all the people there. And he was right. At the time I was still active duty. I was a lieutenant colonel in the Marines, which is something. Well, in the Marines it is. Outside the Marines it's not. But, so I had achieved a certain level of success there. I'd been in leadership positions in the Marines for, almost 20 years at that point. And yeah. So when he said that, I started walking around and talking to everybody and realizing, there were people that didn't have college degrees, that didn't have, lots of leadership experience, that didn't have, a lot of this skill set that I had, that were doing exactly what I wanted to do.
Yeah.
And at the end
And
of
at
that,
a higher level, right?
yeah.
Like they were doing it at way higher levels.
And I mean, quite frankly, there were some guys that were probably idiots that were doing it, and they had a good team around them and they were successful. But
So maybe they were not idiots because they realized their limitations and they built the team around them.
True. So what I guess there are guys that were academically not very smart is what I guess what I meant by that.
Yeah.
When you look at can they spell words? No, they can't. And so, but yeah, I mean, all these skills that I had kind of cultured over the years. I've got 2 graduate degrees and but like all these skills that I had kind of equated to being successful up until then, there were guys that barely finished high school that were putting together these portfolios, right? And so when it comes to like standardized tests, they
No,
were,
I know exactly
yeah.
what you mean. I had the
So
same kind of highlight in kind of my career where I was like, I've had this corporate, background and I worked in Fortune 50 companies and had massive teams behind me and worked through all these projects. But at the same time, I was also listening to podcasts, listening to these different things and noticed, and there's like, no offense, policemen and teachers and all these other people that have hundreds of, maybe thousands of units at the time, or even was a couple of hundred units, and I had nothing. So, it really is a mindset shift, and kudos to those people for taking action, right? I think it's important to, take that mindset shift, but then not just become a student of information, but be an action taker, right? So I love that about your story. And also, if you're a military guy, you got to execute. So that's huge. And then, bring in that capital, connecting the equity to the execution is just a awesome combination. Yeah. Tell the listeners about Streamline Capital Group and what your approach is and kind of, the locations you guys invest in. Love to hear more about that.
Yeah, well, there's a singular location, and I mean, this came over years of doing other things. I think I've owned properties in 11 different states now, and one day I kind of realized that, portfolios in 11 different states or properties in 11 different states was not easy. Now, I wasn't the person where the rubber met the road on the management on these properties, but I started thinking, what if? And there are a couple of properties that I have taken over management, that are in other states right now. And, after seeing kind of like the headache that a very wide dispersion of properties gives, I decided, I need to focus. I really did a lot of thinking about this and, what the benefits of focusing were. And so I decided to pick one metro and focus on it. And fortunately, the metro where I grew up, Salt Lake City, is a very good metro as far as growth and everything else. And so, right now, we got 4 properties and 150 units. And I mean, Salt Lake City prices it's not cheap. So, 150 units in Salt Lake City is, ballpark 35, 40 million worth of acquisitions. And so that's what Streamline manages right now. And incidentally, I did start Streamline Capital fairly recently and only to invest in Salt Lake. So all my other holdings are
like other partnerships and stuff like that.
Yeah, they're other partnerships. And so,
okay.
So we were basically looking for, I like growing areas, and in lots of parts of Salt Lake is in a valley. There's mountains all the way around it. The northwest corner of Salt Lake City, you have the Great Salt Lake, right? But for the most part, there's geographical limits, to Salt Lake City. And right now we're seeing more infill than anything else. We're seeing small buildings go down and big buildings go up. And so, my approach is we're looking for the areas that are rapidly improving, and we're essentially jumping on that bandwagon.
Right. So following the path of progress in
Yeah.
Salt Lake, just we want to invest where other capital's investing, which is, that's a smart thing to do. Yeah.
Yeah. And we don't want to be the first ones in, and we don't want to be the last ones in,
Mhm.
I mean, a neighborhood that's, been 50% renovated is about perfect for us. If we're the first person to renovate something on a block, we're probably too early, it's kind of how that works. Yeah, that's the goal. And, ideally we pick up something that is, kind of a seed plus class apartment complex. And we've got to be able to move the needle to a B is what we're looking to do.
When you say move the needle to a B, for the listeners, what do you mean? Is that like in terms of rent or in terms of value? Or how would you do that?
Well, really, so I'll tell you why first. I mean, when you look at valuation on multifamily, a B class property is going to have a lower cap rate, which means a higher valuation, right? And so, I mean, everything else exactly the same. You change a property from a B class to a C class or C class to a B class, you're immediately
And the other
adding.
way.
Yeah, I said it wrong the first time, but a C to a B, you're immediately adding dollars to the purchase price, right? Or to the value. So now what's the difference between a C class and a B class? Mostly finishes and amenities, and so, we want to come in and we want to, fix it up and make sure everything is consistent, and make sure everything looks good. And then look for places where we can add amenities to kind of move that needle. And so, on some properties we're looking at, hey, can we put a stacked washer and dryer? Or if we have properties, that's one of the things that like a lot of B class property, one of the things a lot of B class apartments have that C class typically don't is like the laundry. So can we get laundry in here? And then we look at the amenities on the exterior as well. Like, is there anywhere out here we can add amenities? Can we put in, a pergola, a gas grill? Can we put in a small playground? Can we put in extra amenities to help move the needle here? And we also like to, kind of look at demographics and try to figure out what amenities are going to give us the most bang for your buck, and so in most areas of Salt Lake, there's a really high birth rate in Salt Lake, and so one of the highest in the nation. And so there's a lot of kids there, and so a lot of the amenities that we're bringing in, kids and pets are kind of like the biggest focus for us on amenities, kids and pets. And
So you're
so
putting like playgrounds and dog parks and that kind of thing?
playgrounds and dog parks and the little stations with the little dog bags, so
Yeah.
people can clean up after themselves. And so, yeah, that's kind of what we're looking to do is just like add those extra amenities. We have one property where we just put self-storage units in, so now we have one self-storage unit for every single apartment. Every unit has its own self-storage unit, which, we're charging, $50 per month on these storage units for rent. So it's an immediate increase in our
Yeah.
income,
Right.
but it's also
Are these standalone, like a separate area in the community?
what we did is we had some room. This particular apartment complex had covered parking, and we essentially built the storage units. The front of the storage unit is under the covered parking, and then it sticks out behind the covered parking. And so, we used 1 or 2 feet of the parking space. We ended up building 9x6 storage units. And so, yeah, we did trim a little bit of the parking space off, but we just used the space behind the parking to fill them in. And so, if you look at it now, people pull in, they have an assigned parking spot, which we're charging them for. And then they also have the assigned storage unit.
Yeah. That's awesome.
So we're getting an extra $75 per month just by, assigning the parking and assigning the storage units. But also when you look at the C to B class, that's an extra amenity that we can showcase.
Right.
And when the appraiser comes in a year or two from now and we're looking to either refinance or sell or whatever, they're going to look at that. And like I said, the goal is for that appraiser to look at this and say, yeah, I can call this a B class, and really want that B to be on there.
And you would naturally attract a better tenant because you have those amenities, right? It's, I would I would see that happening very naturally.
Yeah.
Yeah.
And something else, a lot of people, and I'm talking syndicators, maybe newer syndicators, have a tendency of an inside out approach when they do the renovations. And so we're seeing a lot of properties that the exteriors have been neglected. But maybe the interiors haven't, and some of the interiors have been, well renovated, but the exteriors have been neglected. So we are putting a lot of money in the exteriors as well. I want my asphalt to be black.
Yeah.
I mean,
Not
that's what I
catchy.
want. Yeah,
Yeah.
black with really high contrast lines, yellow or white or whatever the city code tells us we need to put on there. But, I want everything to look good. Like we spent $75,000 on brand new decks at one of the properties,
Hmm.
and the decks they weren't terrible, but they didn't look awesome, and
Yeah.
so
Yeah.
what we want.
Enhancing that curb appeal,
Yeah,
right, of the property, making it a better community for the
exactly.
residents, right? It's beautiful. Yeah, no, I agree. That's, I've seen a lot of deals go sideways where, people are, let's bring in the dumpster and just start tearing up the interior. And, now you've taken the building down. And guess what? If you don't have to do that, focus on the exterior, make it more of a community, and then phase in the upgrades like over time as people move out. That's always been our strategy too. That's awesome. What a great tip for listeners. If you're in the multi-space, and make that curb appeal like the focal point, and you'll get a better tenant that way.
Yeah. I actually learned that. I think where it really struck out to me is I met somebody else that lived close to me that had apartment complexes close to me,
Hmm.
and he invited me. He's like, "Hey, do you want to come look at my properties?" I'm like, "Yeah, sure." And I remember going to one of them, and he was putting in, $25,000 into the interiors, and was doing a really good job. I mean, they had built laundry closets, and they were moving things around, and so I mean, they were doing a really good job. I was able to see something they hadn't renovated and something they had. And I mean, let's face it, adding laundry inside is actually pretty expensive by itself. And they were putting brand new appliances into everything. So just like top of the line renovations, but the exterior of the property, it was built in the 60s. And I mean,
Yeah.
but there was just no landscaping. There was trash all over the place. There was weeds,
Yeah.
growing through cracks in the parking lot all over the place.
Hmm.
And I remember saying to him, I'm like, the interiors are beautiful, but you look at the outside of the building and nobody's going to even want to stop to look at the inside. And that was like a light bulb moment for me and him. He actually, we've talked several times since, but he's actually changed his philosophy after that conversation. But it was just like, if I don't care how good it looks inside, I personally never would have gotten past what I'm seeing right here.
Yeah. Yeah.
I mean,
That makes so much sense. You're not gonna go. You don't want to step into anything if the presentation is horrible. Like,
yeah,
because who else is living in there, right? Like, so yeah, it's superficial, but it's important. It really is. And especially when you're trying to have that value add impact into those communities.
yeah.
I had a question on, multifamily. As you scale, you're growing, and you're getting to larger projects, and so forth. Multifamily is a capital intensive, you know, type of asset. What advice do you have for someone looking to really break into the space?
I think more than ever before, focusing on the capital is what's gonna set you apart, right? I mean, and this is another thing that I realized along the way. If the only thing what's the best way to say this? If you have a property that's you're $10 million and you have $10 million in your back pocket, guess what? You're going to close. All right. Nothing else matters at that point. So if you're able to bring money to the table and large amounts of money, you're going to be able to buy essentially whatever you want. All right. And the brokers are going to understand that. And if they know that you're able to fund things and fund them quickly, they're going to show you everything because brokers are looking for quick and easy. I mean, that's what
Yeah.
I mean. everybody's looking for quick and
Yeah.
easy. So it's not just the brokers, but they're looking for quick and easy. And so if they know that you're a quick and easy closer, they're going to start bringing you properties first, and you're going to have first look. So out of everything there, I mean, some coaching courses, focus on underwriting, and others focus on operations. And I'm not saying they're not important, but out of everything we do, I think the most important part is the capital, is equity, raising equity. Debt's pretty easy. I mean, you assemble a team, you get a property under contract, the lender's going to lend, right? But if you can raise equity in large quantities, you're going to be able to do whatever you want in this industry.
Where do you suggest, I think you kind of highlighted on this in the beginning, but where do you suggest someone start that journey? Because I agree, I think it's that last 25, 30% that you got to put down. Sometimes it's the hardest, right? So, how do you approach your equity today?
Well, I've been doing this for a while, so I do have, a list of people who've invested with me. I've had a couple hundred people that have invested with me in the past. And so, right now that's the first thing that I'm looking out for is people who've already invested with me. But, that's not true of anybody who's new. People who are newer to the game right now, I think you just have to sit down and take stock of what assets you have, what relationships you already have, and see, what the best path forward is. With most people, it's friends and family on that first syndication. That first investment is largely friends and family, because professional investors, high net worth investors, they're not typically going to invest with a first time property owner. So you're really looking for people with whom you already have a relationship and who trust you enough to put in $25,000, $50,000, $100,000 chunks to get that first deal across the finish line. And then from there, it's just a matter of expanding your circle. For everybody, it's different. For me, it was going to a lot of in-person meetups and a lot of LinkedIn. And that's how I started expanding. Now, I think that now, several years later, we're growing our investor list most by paid ads. I don't think, I wouldn't recommend you start with paid ads. But, I think if you start with your friends and family, you find a partner or two that can also leverage their friends and family. You can probably, 3 people leveraging friends and family can probably raise $1 million and buy a $3 million apartment complex. That's reasonable. And then keep on improving. So, everybody has a slightly different situation. And so, really just look at what relationships you have, what relationships you can leverage, what communities you can leverage, what memberships you have and you can leverage. And from there, just kind of build a plan on, how am I going to market myself? How am I going to, get in front of these people? How am I going to start conversations? And then just talk to more and more and more people.
Yeah. That's so huge, guys. Like, networking is so critical in this space. And the first deal, you may have to just do it yourself. If you've got the capital, save up and do that deal yourself. The second deal, you bring in, a partner or two and you scale that way. Now you've got a bit of a track record and you build that track record, you build that success, and then you expand that network while you're going through that process. It really is a network effect kind of thing from a marketing standpoint. And your net worth is a kind of a cheesy saying, but it's so true. Your net worth is your network, right? So the more people you surround yourself with that are excelling in this space, the more likely you are to get lucky and find that person that has capital that's really looking for a deal. Remember, we're the conduit here, right? So what Brian's saying is, and correct me if I'm wrong, we're the conduit for a great deal in capital. So we need to bring those parties together. And that's kind of what you're doing in Salt Lake. So that's awesome.
Yeah. And if I could add to that, it happens in increments is what every once in a while, you'll find somebody who can really move your business forward. But realistically, it happens in increments. You're not going to go from friends and family to getting people to write you 8-figure checks overnight,
Yeah, no.
right? You're going to start out getting $25,000 to $50,000 checks, and then on, subsequent capital raises, you might get $50,000 to $100,000 checks, just from more people, but it's going to be a very incremental approach.
Yeah.
I mean, always keep trying to, get those large investors, but, realistically, you know, um, it is going to be incremental. And, I think I've mentioned this on a couple minutes ago, but the large investors aren't going to invest into people who are new. So the more experience you have, the easier it is to attract the higher net worth investors, the people can then write larger checks. But it's an experience thing, in a lot of ways. It's going to be, expanding that circle, and keep on expanding that circle. For most people, that's what it looks like. It's slow growth, not, I got $25,000 checks from friends and family, and we just bought a $3 million property, and now I just got somebody to fund a $30 million deal. Doesn't typically work like that.
Yeah, no, that's so true. Shifting to, kind of where we are in the market and the cycles today, what, with today's, I would call it economic uncertainty in the multifamily space, with the higher rates that we have been experiencing over the last, 4 years, 3 years. It's been pretty brutal out there. And then also, we've got our consumer being pressed with having less money in their wallets every month. How do you navigate these cycles?
It has been more difficult raising money right now. It's the easiest place to raise money, 3 years ago, were from people who had invested in apartments and had just had an exit. And that was happening quite a bit. In 2020, into 21, it was very common for me to have somebody call me and say, "Hey, Brian, I just found out that one of my deals is selling. I invested 50, I'm going to get 100 back. Do you have a place where I can invest some of that?" And that was a very common phone call that I had 2 or 3 years ago. Right now, transaction volume is extremely low. People are only selling if they have to sell, and most people that are selling at a loss. And so we're not getting kind of like that rebound money. And so it is a little bit more difficult to get people to invest. As far as interest rates go, I think pricing has dropped significantly in multifamily in the last 2 years, and it doesn't fully compensate for where we are with interest rates, but I mean, it comes close. Yeah. So interest rates it went from, like, we were getting Freddie Mac loans in low to mid threes, a couple of years ago. I got a bridge loan at 3.7.
Yeah. Oh yeah.
I mean, fixed rate, 3.7 fixed bridge. And right now, Freddie and Fannies are in the sixes. So you're paying almost twice as much for your debt. And so when you start looking at it, most multifamily prices have dropped about 30%. And so there has been that correction. Has it been big enough is really the question that I don't know the answer to yet. But it looks like values have started to go back up in most places. The other big thing that's affected pricing is how many new units hit the market in 24 and now in 25. And in Salt Lake City, we're past the big clump of units to hit. And Salt Lake City was one of the high growth, one of the metros that got a lot of new units. But, where we're looking at an average year in 25 for deliveries and 2 straight below average years in deliveries. So all the things that led to this market crash in a way are looking like they're starting to correct themselves. 1 year of average deliveries followed by 2 years of very low amounts of deliveries. We should see increases in pricing, and we should see increases in rents, that we haven't seen in the last 2 years. Interest rates, if they stay where they are, prices are going to go back up. If they go down, they're going to go up faster. If they go up, we might have a little bit more of a correction. But, I think right now where we're at, we're kind of like at that inflection point where things are starting to go up, And my crystal ball says, 3 to 5 years from now, everything that I buy right now is going to be worth more. So that's what I'm trying to convince people, especially the investors, is that right now is probably the best time to buy that we've seen in a decade.
Yeah, we've certainly come around the curve and we seem to be heading back from the bottom. Yeah. So that was my next question was, what's your next 3 to 5 year outlook? And I think you answered that. I'm in full agreement with you. I think, whether rates go down quickly or slowly, asset values will increase. So, especially risk on assets. So awesome. Tell me about the coaching business or that you founded. I think it's called, is it Tribe of Titans? Is that
Tribe of Titans? Yeah.
okay? Yeah. What inspired you to start that?
When you look at what I'm naturally good at, teaching is one of those. I've always wanted to be a teacher, and I realized a long time ago that I enjoyed the conversations more with people that were saying, Brian, can you help me do this? Than I was from talking with investors, right? I get more excited, talking to coaching clients than I do to investors. Investors, are really going to move my business forward, but that's not, so anyway, there's a huge market for coaching. And so I realized that I was essentially doing free consultations and free coaching for a long time. And I decided, I had an epiphany one day where I realized that, most of the people that I was helping would be maybe 1 or 2 calls, and then I would never see them again. They'd call me up, and then maybe 4 or 6 months later, they'd call me up again or send me a note and say, hey, Brian, thanks very much. Your help has really helped me to get going. But I realized that if I truly wanted to help people in the manner that I wanted to help, I needed to have persistency. I needed to be able to have multiple touches over a year and not just one-off phone call. So yeah, I started creating content, in some cases accumulating, but started creating a bunch of content. And I started, small courses. Like I started doing like underwriting, did like a weekly underwriting class, which was the big secret. That was me building content. I started doing, a capital raising series, hey, this is how you raise capital. And that was me building content for the capital raising course. But about 2 years ago, I decided to formally launch it. And I want to keep things small. I don't want to have, 1 million students that I did Michael Blanc coaching, and I don't think I met Michael Blanc until like the 6-month mark, So yeah, when you start looking at I like the personal touch, I like getting involved, but I've also realized that, if I'm going to spend time with people, the amount of time it needs, I have to be compensated for it too. So I'll pull all of that stuff together. I formally started the coaching program, and now, when people sign up, they have me for a year, and so 12 months, I've got 12 months where we're doing 2 calls a week, 2 group calls a week, and then, 2 monthly individual calls. And that's enough. That's enough to help people who want to be helped get to, understand the business and get their first and potentially second acquisition, in that year. So, it really came out to, what am I naturally good at? I love teaching. I'm going to stop teaching, so I might as well, do it better and monetize it.
And there's a certain reward for seeing someone that was in a position that you were in years ago and being able to help them clear up those bottlenecks and drive them to success. Yeah, that's awesome. For someone that's feeling overwhelmed but wants to start, what are the first 3 steps that they should take?
I've always the next 3 steps, so first 3 steps, whenever I got overwhelmed, and this is something I learned from my mentor, and kind of disappointed that you said first 3 steps, because, every time I feel overwhelmed, I sit down and I think, what are, from where I am right now, what are the next 3 steps that I need to take? All right. And I'll get really clear on what those next 3 steps are, and then I'll pick one and do it. Now, sometimes, my mental state is such that I pick the easiest one. I grab the lowest hanging fruit and I do it. But I would say first three steps. Number one, you've got to figure out what you want, right? Figure out what your vision is, So why do you want to get into multifamily? All right. And if you can't answer that question, you're going to burn out really fast. Okay. For me, I was 17 years in the Marines. I had just deployed, for the nth time, and left my family for a long time, missed a bunch of birthdays and holidays again. And I wanted out of that cycle. Right. And so for me, getting into multifamily was getting myself out of that military deployment cycle, and getting myself home with, my wife and kids. So yeah, first thing is just figure out what you want. And then, once you do that, I think the second thing is, take stock, be honest with yourself. What are your resources? What do you have available? What relationships, what money, what capital do you have available? And, from there, I think the third thing is just basically build your own roadmap, figure out, okay, here's where I want to go. Here's my starting point, and then essentially draw a line between starting point and end state,
Yeah.
But yeah, if I had to say three things, that'd be the three. And incidentally, that's how I start with every coaching client is, we build a roadmap, and we spend a lot of time, thinking about where do you want to be 5 years from now? Do you want to have a job, or do you want to be full-time in multifamily? Depending on your answer, you might do things differently. There's plenty of people who are, maintaining full-time employment and still doing very well in this space.
Yeah. No, that's so true. I think, having your vision set and understanding, the end target, the goal in mind and working towards that is so important. And so, yeah, listeners, and, one other thing is find yourself a Brian, right? Like find a mentor. I think that's huge. Like that's going to shorten that roadmap by years if you have the right coach and mentor in your corner. So, yeah, Brian, this has been amazing. I've really had a wonderful conversation here with you, and very excited to learn your story and about Streamline Capital and Tribe of Titans. What's next for you guys? What's on the horizon?
More of the same, just doing it better, where we're going through all of our processes right now internally. And there's something that I read recently that I think is really what my focus is. I want to have $1 billion in assets under management. Right now it's over 100 million, but I want to get to that $1 billion mark. And really what's going through my head right now is we need to act like we have $1 billion. We need to operate like we have $1 billion under management right now. Otherwise, we're never going to get there. And so, we're going to continue to do what we do. We're going to continue to buy properties. But, what we're really focusing on right now is trying to get all of our internal procedures down so that we are internally acting like we're a company with $1 billion in assets. And so, yeah, we're kind of like working on the inside while, we're still purchasing properties. We're closing on another one next Friday, but, yeah, we're going to keep buying properties, and we're going to keep, working on ourselves and working on our processes and make them better. And the process that we've been focusing on for the last couple of weeks is our capital raising process, and once we have a really good spot on that one, then we're going to turn to our asset management and basically plug in all the holes. It's not that we don't have a process right now. We're just
improving on it.
We're improving everything. Yep. So,
awesome.
So yeah, that's the goal.
Yeah. Love it. Growth comes with reiterations, right? You got to go back to each thing and how can we improve this process, and then add more units to the process. So awesome. Brian, tell me where can the listeners reach out to you and find out more about Streamline and Tribe of Titans?
I would say best place is LinkedIn. I'd give you my email address, but I've got so many unread emails right now that I might not answer you, but reach out to me on LinkedIn. One thing that I do, I will respond to every LinkedIn request that I get.
Amazing.
That's kind of been my bread and butter for finding investors, finding coaching clients. And so I'm probably twice as likely to answer something on LinkedIn than I am to answer something emailed to me. Reach out to me on LinkedIn. If you're not connected with me, hit the connect button. If you are connected with me, hit that message button and send me a note. Joseph, by the way, I sent you a LinkedIn request this morning.
Okay.
If you're on that platform at all, give me a connect too. So
Awesome.
Yeah.
Listeners, I'll leave the description in the link in the description, and please go ahead and join and connect with Brian. Brian, thank you so much, and have a beautiful day, and good luck on those closings and prosperous 25.
Thank you. Appreciate it.